Gold trades with a notoriously high beta. It is erratic, explosive, and capable of moving $20 to $50 in a matter of hours. Look at this chart. We see those wild vertical swings collapse into a tight horizontal channel. While amateurs search for excitement elsewhere, institutional players monitor this channel as a coiled spring, accumulating tension for a violent expansion. But knowing a breakout is imminent is only half the battle. The big banks routinely engineer fakeouts, specifically designed to trigger retail stop-loss orders. They push the price above resistance. Retail traders assume the breakout started and flood in with buy orders. Banks use that liquidity to sell, instantly reversing the trend. Surviving these liquidity hunts means stripping away the guesswork. Professional traders process every potential gold setup through a strict three-part sequential filtration system. Because chart scales can easily deceive the human eye, a true volatility vacuum must be quantified mathematically before you even consider a trade. On a 1-hour chart, we wait for the Bollinger Bandwidth to drop to its lowest 20-period point. Next, the 15-minute average true range must drop 50% below its 14-day average. When both the Bollinger Bandwidth and the ATR hit these mathematical extremes, the first filter is clear. The spring is officially loaded. A mathematically perfect squeeze will still fail if it triggers at the wrong time of day. Sustaining a trend in gold requires massive institutional-level liquidity. This timeline maps daily trading volume. Notice the massive peak between 13 and 17 GMT, the overlap between the London and New York sessions where peak futures trading occurs. Breakouts that happen earlier, during the lower volume Asian trading session, consistently lack the follow-through required to hit profit targets. To guarantee that big money is actually driving the move, we look at the tick volume indicator. We require the breakout candle to be paired with a volume spike that is at least 1.5 to 2 times higher than the recent 20-period average. By verifying the overlap window and measuring that specific volume surge, filter 2 is complete. You have confirmed institutional backing. Even with correct timing and compression, you still have to interpret the exact moment of the breakout. This is where most traders fall into the bank-driven stop run. Entering when price touches a new high is a mistake. A wick is a lie. Let the 15-minute candle close entirely above resistance without pulling back. Then the solid body must make up 70% of its total length. When you have a strong 70% body closing outside the zone, you clear the final filter. You have verified aggressive intent from the big players. With the setup confirmed, you have 2 options for entry. If momentum is surging, you can execute an impulse entry, placing a market order the exact second that 15-minute breakout candle closes. Alternatively, you can use a throwback entry. You wait for the price to drop back down and test the old resistance level, which now acts as support, and catch a significantly better entry price. Regardless of how you enter, a standard 20-pip stop loss will get immediately triggered by gold's natural intraday fluctuations. Instead, use a volatility-adjusted stop. Take the current 1-hour average true range and multiply it by 1.5. Set your stop loss exactly that far below your entry point. Relying on the dynamic, mathematically derived stop gives the trade enough breathing room to survive the initial turbulence of the breakout. To project your target, look at this measured move technique. We measure the exact vertical height of the initial consolidation zone and stack that same distance on top of the breakout point to set a precise take-profit order. Find the mathematical compression, filter for the London-New York overlap volume, verify the 70%